Very good afternoon, everyone. Welcome to today's uLaw webinar. The topic for today's webinar is Law Society Bookkeeping Compliance. This particular webinar has been accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. I have included the title in our chat window as well, but I repeat, today's webinar is accredited for 1 hour of professionalism CPD credits, and we encourage you to use your individual Law Society websites to use the title Law Society Bookkeeping Compliance to get your 1 hour of professionalism CPD credits. At all times, as always, please do use the chat window to ask any questions that you may have pertaining to today's webinar. It's recorded and will be available to you on our YouTube channel on Monday. Like every other uLaw webinar, today's webinar being a CPD webinar in nature has this specific set of agenda items. We're going to specifically talk about the bookkeeping related compliance documents. And when I talk about bookkeeping, I'm of course leading to the financial aspects of your legal business and how the Law Society auditors or the Law Society compliance request you to tell the story about your financial bookkeeping and how money has entered and left your different bank accounts, especially if you have trust accounts as part of your practice. And all of the complementary set of documents, whether they are the journals or the ledgers and other documents that tell the complete picture and story to the auditors about your discipline, your bookkeeping compliance, and ensuring that you're meeting the guidelines, the bookkeeping guidelines of your individual jurisdictional law societies. Okay, so we're definitely going to talk about the top documents that we would like for you to keep in mind, no matter what system you're using to manage and maintain those. Of course, leaving you with a question to ask yourself about how you do this today, how you manage this whole practice of delivering these set of documents today, especially given the nature of the business that you are required to generate many of these documents on a regular, consistent, at least once a month basis. So really the question is to how do you manage these set of documents and how best you can do so. I could see one of our participants want to present. I do request, I'd like to be the presenter for today. So hopefully you're still able to see my screen, and I'm going to continue to accept our participants in. So definitely talking about the trust and general ledgers, what does it take to maintain them. We'll then talk about the journals, especially the receivables and the disbursement journals, apart from the trust in general, of course. Specifically highlight the reconciliation process. I hope you're all able to hear me. Please do give me a thumbs up if you are. I do see some of the participants not being able to maybe hear me already. So the reconciliation process, really how you should really approach the whole reconciliation process, especially if you have trust-related reconciliations, right? And how can you simplify this process? I do want to repeat this. I'm sorry I'm a bit off because there's a lot of chat window going on. I do kindly request that if your audio is not up to its mark, that you dial into the phone number provided. We find often that the quality of the audio being better delivered if you're able to dial in. because it all comes down to the quality of the internet if you're listening to this using your desktop or laptop or your mobile devices. So thank you for that. So moving along with the agenda, after the reconciliation process, we'll talk about the fee book, some jurisdictional documents, the Form 9As, the 9Cs, deposit slips, etc., and how they are very instrumental in telling that story as well. For example, the Form 9A, as many of you may already know, is a document in the province of Ontario which you fill out every time that you transfer trust funds from a trust account into a general account in an electronic format. Okay, so it's a document that requests you to fill out the from and to financial institutions, the purpose for that transfer, and some additional information about that specific transaction. And as I said, leaving you with knowing that these are the set of documents that you're required to generate on a regular basis. This is an amazing time early in the year to think about the tools and the different services that you as a legal professional can utilize to minimize the time spent in producing these documents for your legal firm. Okay. Of course, I want to start with a bit of a primer in terms of if you are using a manual system today, wanting you to think about the advent of technology, especially legal tech, which we've been talking here at uLaw for several years now, that legal technology has really come off its age and it's only going to improve to make your lives easier and effective and faster. Of course, with the internet, 5G, with the advent of mobile technologies, and post-COVID really changing the way that we're actually going to be doing business moving forward. But even prior to COVID, the whole aspect of legal tech has evolved to give you now cloud capabilities, especially legal accounting software that have helped pretty much facilitate the whole accounting aspects of your legal business. What used to be a very manual full entry accounting system and how it has evolved over time to now having cloud-enabled legal accounting software that pretty much dummifies this whole manual process of having to manage these ledgers and journals in a manual basis, whether that's spreadsheets or documents that you otherwise have. Evolving to, of course, the general accounting software, which is still very effective if you're not necessarily utilizing the trust vehicle of your legal business, but knowing that the trust account is available to safeguard your business's financial interests, we beg to differ by saying that you probably should think about going forward how best you can utilize that trust account. Of course, as and when prudent, and if prudent, to the line of business that you're dealing with and the areas of practice and your style of doing the business. But just so that you understand that you have come a long way, the legal business has come a long way, and starting from a very, I would say, time-consuming manual double entry, you now, as a modern legal practitioner, have the advantage of utilizing the tools and techniques that have evolved over time to give you these inexpensive, anytime, anywhere access to powerful legal accounting software that pretty much does the job for you. And in terms of doing the job, as I iterated earlier on, every legal firm, of course, has its own life cycle of how you manage your business, your clients, your different matters for each of those clients. And as you start to incorporate your own best practices into managing the client relationship, in managing the aspects of your matter, whether that's docketing on time, generating invoices on time, ensuring that the retainer funds upfront have been deposited appropriately into the trust accounts, providing your clients with those trust receipts. These are, of course, very important. These are very, very important aspects of your day-to-day operations of running your legal firm. That as these transactions, especially the ones that have that financial component behind the scene, those are the transactions that are very important for the Law Society to review as either an audit or as a spot audit, or requesting you to generate these documents that when that time comes for the audit, that they are able to go back in time and review these documents so they can quickly understand how well you've managed those transactions that are financial in nature, keeping in mind the bookkeeping compliance aspects of today's webinar. Okay? Of course, there are other aspects of the compliance that are client-related, matter-related, your overall operations-related. But focusing on the bookkeeping aspects, the financial aspects, we want to think about what are those transactions that translate into these financial transactions, and how and when do you generate these documents, and what are the data elements that need to be captured in these transactions. So if you look at a trust ledger, so let's assume that your legal firm does entertain the use of trust account. You are accepting, let's say, a retainer as you engage with the client. Then the transactions that have to be captured and reflected, recorded and reflected, are both where you receive funds and disburse funds from that particular trust account. So of course you go into a financial institution, whether that's a bank or a credit union, you set up your financial account, and maybe you have a general account, your trust account, right? And as you receive funds, let's say you receive a $1,000 retainer, that $1,000 retainer is what you received, that goes into your bank account. And that particular financial transaction pertaining to a client's matter now becomes a point of interest within this one document called the trust ledger. And what is required to be captured is the date in which that transaction occurred, right? So it's a real-life transaction, so it happened at a particular date. The reason for that particular transaction. So why did that money come into your trust account? And that's what they're asking for in particulars. So even if you're using a manual system, something for you to keep in mind that these are some of the particulars that we encourage you to note down so that you can reflect them in those appropriate documents. So the date, the particulars, which is really what was it for. And when we say what was it for, in legal lingo, you may want to boil it down to who was the client and what was the matter. And the third aspect that can give you a little bit more information was the reason behind it. So it could be a retainer, or if you're in real estate, it could be a different reason, right? So for different areas of practice, there could be different reasons for which money is now entering that trust account on a particular date. The third most important aspect of that, especially when you're receiving funds, is, all right, how much is the amount? And the reason for us to capture that exact amount is because at the end of the month, you are now required to reconcile your trust account with a final balance on a certain date, right? And hence, it's very important that you capture these three important data elements: the date in which you received that money coming into the trust account, the reason for that money coming into your trust account, and the amount of that financial transaction entering that trust account. Now the fourth or the fifth column in this particular example, if you will, is the balance. And that's the running balance, as they call it, which is as of this particular date of August 30th, what was the balance? Because you can see a difference between just these two dates of August 30th and 31st. That on the 30th, when we got that $40,000, the running balance end of that day was $40,000. Whereas on August 31st, when that money was moved from trust into assuming and general account, the balance became zero. So the running balance is another very important aspect of this trust ledger document. And you can see the fourth column is the disbursements. So in a single document, you're pretty much capturing by date and by particulars and by amount the money received and the money that has now left the trust account or dispersed from the trust account, leaving with a running balance. So if this amount, for example, was $20,000, then you would see the running balance in this example as $20,000. First and foremost, demystifying, if you will, the trust ledger, this is what it boils down to. The trust ledger, again, as part of the expectation from the Law Society, is that you also categorize this or group this by client and matter. So these particulars are very specific to this client, Kim Kirby, for this particular matter, loan to Taylor. As you can see, the next set of columns now relate to a different client, Peter Piper, for matter, corporate matter. So you can see now this ledger is now categorized or grouped by the client and matter. If you have multiple matters for the same client, Kim Kirby, then of course you would have one set of transactions for the first matter, which would be loan to Taylor. Assuming the next matter was a small claims matter, a slip and fall, you would then have another column or set of transactions for Kim Kirby's small claims matter. Okay? Hopefully I've not over-explained myself here, but this is the fundamentals. Whether you use a paper-based trail, a manual entry, a more sophisticated cloud-enabled accounting system, which hopefully should give you this automatically, this is really what's going under the hood, behind the scenes, however you like to call it. This is the trust ledger. Now, another type of ledger, of course, is your general ledger. If you're using a trust account, then of course you make money for your legal firm by doing those eligible trust transfers from the trust account into the general account. So only when the money lands in the general account or your operating account, of course, are you going to make money. You're not making money for your business when the money is staying in the trust account, right? Now, from a general ledger perspective, if you look at this particular example, here are some of the data elements that you want to keep in mind as you produce these documents, again, in whatever means that you may have. The date, you can see that's a commonality between the trust and general. The particulars, so why did this money come into this general account, or why did this money leave this general account? Straightforward. Now, because in the legal business, your firm may be spending money on behalf of both your office as well as specifically for the client called disbursements, there's a column called expenses, which are the disbursements. That's a special column specific to this client. So the general ledger is expected to capture the disbursements that you've spent on behalf of the client, in addition to, of course, the legal fees that you may be charging the client as part of that general transaction. And now comes the aspect of the actual amount that you're charging with any jurisdictional taxes that you may be charging. If you're not charging the jurisdictional taxes, then this column does not have to be filled where it says HST. That's specific to Ontario. Could be GST, PST for legal practitioners in Canada. And then there's, of course, the total payments and similar to your trust ledger, you have a running balance. So if I were to quickly review this document, on July 2nd, and this is, of course, an example taken from the bookkeeping guidelines of Ontario, on the July 2nd, for this particular client, Jackie Jones, you can clearly see there was a fee of an invoice that was generated, invoice number 001. And when the auditor looks at it, this is exactly how they're kind of demystifying or breaking down the information. Perfect, you've got the invoice 001 for $113. And the $113 is a $100 fee with $13 tax. Right? So the $13 tax is something that's of a liability to you. Depending on how much of taxes you've paid or received, you then owe the government back or should expect money from the government, right? And then on the 22nd, it says the client, now there's a payment made on the account of $113, leaving a balance of 0. The same thing with Peter Piper. You could see on the July 5th, let me combine now the trust and the general. Maybe this is a better example. On July 5th, Peter paid your legal firm a $565 retainer that was now received on July 5th at $565. And when you compare it with the general ledger, you now see the next insight into that story, that on July 12th, you generated an invoice 002, which was for the total amount of $565, but broken down as $500 being the legal fees and $65 being the taxes. And on July 14th, you did a trust transfer equating to that amount of $565 that you generated for Peter Piper, and you removed it from the trust account. It was disbursed from the trust account, and now it entered the general account on that same day. Okay, so that's the whole trail, if you will, that an auditor is looking for by having a trust and general ledger side by side, which pretty much tells you the story that for a matter of corporate, for a client Peter Piper, this was how the finances came in and left both your trust and general account. Okay, so we've now looked at two set of documents, the trust ledger and the general ledger, the data elements, and how potentially an auditor may look at these two documents side by side to give them the financial audit trail. If there are any questions so far and everything that I've covered, please do use the chat window to ask that. Now we move on to another set of documents, the journal. Now, the journal is an interesting document purely based on the additional data elements that are captured in this document, now to tell some extra pieces of information, if you will, about that same story. When you looked at the ledger, let me just quickly go back to that ledger slide. Now, we really didn't care how did Peter Piper pay this legal firm that $565, right? Nowhere are we capturing an aspect of that financial transaction, which is how did the payment come in? It could have been a cash retainer. It could have been paid by an electronic email transfer. It could have been paid by check. That's the aspect that comes in the journal. The journal, believe it or not, comes in very handy even for your own reconciliation perspective, more than even what the auditor is looking to generate out of this. Okay? Now, if you take that same example of Peter Piper from a trust receipt journal where you received money, you can clearly see what should come in to this journal document. You can see there is the date. So when did that money come in? Who paid that money? So you can see there was a client. What was the purpose of that money coming in? The amount. So we have all of these in our ledger too. But you can see this final column, which suddenly gives you a new piece of information to that whole audit trail, which is the method, which is the check. So this could be check, this could be cash, this could be various different methods that you as a legal firm support as a means by which your customer can pay you that trust or retainer amount, right? For example, if this amount was $9,000, and if you see the method as cash, then that's a bit of an alarming situation for the auditor, because there are certain rules that govern as to how much of a cash retainer that you can receive. If I'm not mistaken, I believe the amount is $7,500, at least in the province of Ontario. I do know that that's kind of the ballpark amount. So if you do see that this is $9,000 and you see the method as cash, then of course that's going to raise some flags. And that's one of the important reasons, if you will, that you have that. The other important reason is for your own internal reconciliation, that by whatever chance, when you're reconciling that month end, you're down of 565, knowing this journal entry would give you that information as to how you received that payment to begin with. There's also the disbursements journal. Just like how you have a trust receipt journal, you have now a trust disbursement journal, so a journal for the money leaving the trust account. And if you notice, on July 14th, when you paid yourself of doing that eligible trust transfer, a check was written. Assuming Leslie Lawyer is the actual owner of this legal firm, you can clearly see that the legal firm wrote themselves a check, a trust check, that then they encashed. And the check number was 001, and that went against that legal invoice 002, which was for 565. This is how money left that trust account, and that also relates to our ledger document that on July 14th, that money came into the general account, also left the trust account. So as you can clearly see, again, I'm repeating this, hopefully that I can make this a little bit more clearer. But if I'm repeating myself and kind of preaching to the choir, to apologize for that. But for that 565 that you received, for this one single receipt, there's a journal which talks about the method and how that money was received. And for this trust ledger where money was dispersed, where money left the trust account, there's a corresponding journal document that talks about what was the reason, for whom was that money dispersed, the amount, and most importantly, the method as well. Okay? So now you have two journal documents for trust, if you have a trust account, and of course, two journal documents, one for receipt, one for disbursement, for your general accounts as well. So in total, you can see you can have as many as 4 journal documents in a specific month that you now have to generate. And you can see within the data elements captured in the general receipts and disbursements, you have the date, the sources of the funds. So receipt from, where did this money come in from? The amount and the method. And very importantly, let me use that same example for Peter Piper. The general receipts journal, where I received money into my general account, clearly states that on July 14th, a transfer was made from my trust account for this client, Peter Piper, for this invoice 002 of 565, and it was through a trust check 001. So when the auditor has the trust journal, the general journal, the trust ledger, and the general ledger, I'm sure you can appreciate that they, the auditor, or anyone reviewing these four set of documents would have a complete picture of the flow of money from and to in a particular date time period for a specific client on behalf of your business. So if you just follow that July 5th and July 14th set of transactions, that in itself gives you that picture. Of course, this is a very, very simple, singular transactional behavior. In legal firms, I'm sure you can appreciate that the transactions can be very complex. The transactions volume can be much higher, and hence it's very important that you set a practice or a best practice discipline of how best to not only record these transactions, but make it easier on yourself and your colleagues to reflect and report these transactions in this particular format as expected by the bookkeeping compliance. So far, we've covered a maximum potential of 6 documents, 2 ledger documents, and a maximum of 4 journal documents. Then comes a rather interesting, could possibly be a bit of a time-consuming, but most important bookkeeping document, which is something that the law societies do advocate and encourage legal firms to do on a very regular basis instead of having to catch up at the last minute. And this is the reconciliation process. Of course, we at uLaw do conduct a very specific CPD webinar on reconciliation, both trust and general, and it's very much available on our YouTube channel for you to review. This reconciliation process, of course, if you have a trust account, very important to do your trust reconciliation at least once a month. And it's an accounting procedure that gives you the opportunity to validate and confirm that the transactions that have come in and have left your business in that date range is valid, and you authorize and confirm that these transactions have occurred. Now, the trust account, of course, as you can see, has many legal lingo. You could have mixed trust account, you could have pooled trust account. I think it really comes from Canadian or an American lingo. The trust amount clients pretty much is a document that lists out all of the outstanding balances in your clients on a particular date. A reconciliation document is an outcome of a reconciliation process. So the first thing to do is the reconciliation process. An outcome of that reconciliation process is the reconciliation document for a date range, whereas the trust amount clients is as of any date. So it could be the 10th or 12th or even end of the month of January. What is the outstanding trust amounts against each and every client that you have? So part of the reconciliation document is the trust amount client document as well, which is otherwise called as the client's trust listing. But this is generated typically at the end of the month or a time period. You could be generating reconciliation documents even on a weekly basis if you have the right practice and the right tools to help you do that. So from a trust reconciliation standpoint, the first thing is to actually reconcile. And for this, you need certain pieces of information before you can actually conduct that reconciliation process. One, if you are using electronic financial institutions, of course, log into your appropriate financial institution's electronic account or online account. Otherwise, if you have these print paper documents, then first step is to understand the outstanding balance or the balance as per your bank account on that particular day when you're doing your reconciliation. So if you're doing the reconciliation at the end of the month, as of that date that you're looking to do the reconciliation, what is the balance in your bank account? So if you're doing a reconciliation for the previous month, so you would say, as of December 31st, 2020, if I'm reconciling for the month of December, today rather, then I would go back in time into my bank account and see what was the balance on as of December 31st, 2020 in my trust account. So that's the first piece of information that you need. The second piece of information that you need is a way of reflecting all the recorded outstanding checks and deposits and any bank errors that may have occurred during that time period. So let's say in the month of January 2021, you're looking to reconcile the month of 2020, December, then you would need to know if there are any outstanding deposits or balances and potential bank errors, especially in the trust account. It happens when you're just getting started, where sometimes the bank may withdraw your monthly fee out of your trust account. And this is something, of course, you would have to talk to your bank and let them know, your financial institution, let them know that they should remove the bank fee out of the general account and leave the trust account untouched. Or if a bank error has occurred, if you've caught it in time, you can then rectify the error, have them put the money back into your trust account and then take it out of your general account. If not, then you report it as a bank error if you're catching it at a later time. So the second piece of information is a combination of the outstanding checks, balances, and bank errors. These are the three very common reasons why what your bank or your financial institution tells you as the final balance of your bank account compared to your own bookkeeping of these balances may differ. Okay? So this second piece of information many times is where a lot of time is spent by a legal firm, especially because they're always playing catch up, to really understand what those outstanding checks and deposits are. And let me give you a quick example of a potential scenario. I've explained this, but I'm going to run through this real quick. Let us say that you've actually received a retainer as a trust check from your client. You may have done or maybe you or your colleague or your front office staff may have done a great job of right away getting that check, entering it into your accounting system or writing it down in your accounting ledger document saying, I've got that $565 from this client as of this date, as of December 15th. Now, for whatever reason, and this is a reality and then reality hits many times, let us assume that that check was never deposited into your bank. And what's going to happen as you reconcile the month of December, potentially, if I were to take this example, your internal bookkeeping system is going to show $565 addition to what your bank is going to say, because you've, in reality, not yet deposited that check. That check is still in your, office drawers, in your wallet, purse, and hence the bank is going to be $565 lesser in total amount compared to your own bookkeeping system. So now, how do you reconcile this difference? Is through this addition of a reason called the outstanding deposit. Okay? So you've not deposited that money. And the flip side of that is sometimes if you've written a check to a third party, you have accounted that that amount should be taken out of your trust account. You expect that, let's say you've done you've given back the retainer or the remainder of the retainer back to a client. You have accounted for that money to have left your books, and hence your bank account or your internal bookkeeping would say lesser amount. But assuming that your client, for whatever reason, did not encash that check, then again, it's not going to reflect in your financial institution's account. And hence, as I mentioned, either because of the outstanding checks, deposits, or bank errors. So if you've not caught your bank errors and you're catching it 1 month later, you're going to notice that your internal bookkeeping system would never have caught a $6 money that was withdrawn from your trust account. Right? Whereas in real life, let's assume that the bank fee of $6 was taken out of your trust account, then of course your real life bank balance is going to be $6 lesser than what your internal bookkeeping system says. So this second piece of information, I repeat, would be probably the most important aspect, the moving elements of this document that often a lot of time is required to be spent. Because all other pieces of information is more readily available. Recording the third aspect of this reconciliation, trust reconciliation document, is of course, one of the questions I was asked, the trust listing. So as of this date, so let's say we're reconciling end of the month. As of December 31st, the Law Society expects you to pretty much list out each and every client of yours with their trust balances. So you may have had Peter Piper paying you $1,000, and maybe you've done work for about $300 and done the trust transfer, leaving the trust balance at $700 for Peter Piper. You may have Alex Smith, who paid you $565, and it's a very new client, you've not yet done any work, and hence none of that money has left the trust account, so that would be another $565. So that's how you add up. And those two clients, let's assume those are the only two clients in your account right now, then there would be the $700, $565, leaving the balance with $1,265. So in this particular example, you could see there are three clients. Peter Piper with an outstanding balance as of this date of $1,120. We have Susan with $72 left. Terry with about $523.30 left, and that's the total balance. Now this summation of all the outstanding balances should now match your bank balance as of that end of day, right? Because whatever is in the bank balance and trust account should match with what is the summation of the remaining balances, because that's how the money is in the bank to begin with. Everything else is ins and outs, and that needs to be accounted for in your ledgers and journals. And hence, the fourth step is really to make sure that you compare this, and as of this date, telling that Law Society through this reconciliation document that this is the two sets of data elements. Your trust bank balance, which is coming from your financial institution, and your balances per client's trust ledger that's coming from your bookkeeping system. Okay? So now we have a seventh document as part of your bookkeeping compliance, the two ledgers, the maximum potential of 4 journals, and now a trust reconciliation document. Now, before I go any further, there is a general reconciliation document as well. Now, the general reconciliation document is sometimes not considered to be as highly as important as a trust document because, of course, the nature of the trust document where you're getting money in advance, it's a leap of faith, and hence needs to be really accounted for. The sensitivity of this vehicle, of financial vehicle, is much higher, and hence, of course, a lot of importance is provided to safeguard yourself from making any known or unknown mistakes. But we encourage that every legal firm go through a general reconciliation process in a very similar time manner, because that would allow them to truly have the insight regarding their company's actual profit and loss for that date range. And a big difference, of course, between the trust and the general reconciliation is that in a general reconciliation document, you would not have step 3, which is you don't have a trust listing. You only have step 1, which is the bank balance. Step 2, again, if there are any outstanding balances, bank errors that have not been accounted for, or deposits. And the final step of comparing your general bank account balance with your own bookkeeping ledger, general ledger. So now you have 2 ledger documents, 4 journal documents, a trust reconciliation document, and a general reconciliation document. So a maximum of now 8 documents for you to keep in mind. I'm not trying to add more to this, but it's the reality of the situation. And then comes another important aspect of the bookkeeping compliance set of documents, which is the fee book. Now, why the fee book? After all that we've gone through. If you remember, we had this one aspect of every ledger and journal, which was the reason for the money to come in and leave. And one of the reasons there was an invoice. There's a quick question. Are we saying that there are a lot of people who aren't running their general ledgers monthly? Yes. That's pretty much what we're saying. We're saying that not on a more regular basis, the amount of importance sometimes given by legal firms, I'm not saying all of them, but in a general observation, a lot of importance, sensitivity, urgency is provided into managing and maintaining trust-related documents, especially the trust reconciliation. But we believe if you apply that same level of urgency into your general as well, yes, it's not one of those check items in your compliance documents, but something bigger than that is for your own financial health and financial hygiene of your own business. And the reason we say that is if you can confirm the monies that have come in and left your general account, which is your operating account, you can be very certain about the profit and loss. So if you've got 1,000 and 300 has left your general account, you can be very confident to say that, hey, $700 is the profit this month. If you've not reconciled that month, which means you've not accounted for the money coming in, you've not accounted for the money leaving, then sometimes you cannot be confident enough about vouching for the profit or loss or whatever is the balance left in the operating account. So if you want to be very certain, doing your reconciliation pretty much helps the prudence and the cadence of the numbers in your accounts. So when you're run your P&L, you can be very certain because you've done the reconciliation for that month. Coming back to fee book, let me be very cognizant of time. We have another 10 minutes. So fee book is, as I said, one of the reasons we provide in that ledger and journal is that often we say, hey, that was invoice 002. All right. The Law Society wants to know, was this really generated? How was it generated? Where are you tracking this? So that's the fee book, because the fee book is the reflection of all the invoices, including disbursements. And I underline disbursements because a disbursement is a recoverable income. So you pay this in advance, but in the hope that you can recover it from the client. And hence, it's very important that you do generate invoices in a more timely manner so that you can recover those paid disbursements faster. So the fee book reflects the invoices, any disbursements raised as part of those invoices that need to be recovered. And each fee book does need to record the invoice numbers because, we don't want anyone fudging these numbers, having fake invoice numbers. The auditors may then ask you for the actual trail of showing the invoice itself, sometimes showing that you have sent this to your client. Likewise with payments received, if you receive payments both for trust and general related, so if you received a cash retainer, then providing a retainer receipt, very, very important, especially if it's cash. Because if it's a financial legible way of paying, for example, let me rephrase that, I apologize. If it's a trackable means of payment, which is either through a check number or electronic means, you now have a trackable way. If it's cash, often it's not trackable. You don't have a specific electronic trackable method, and hence the emphasis on the receipt is higher. Likewise, if you received a payment, let's say there was no trust amount involved, you generated an invoice 001 of 113. You sent it to Jackie, and then she was very prompt in paying you back that 113. Then it's recommended that you as a legal firm provide a receipt for that payment, confirming that you have received that payment. Safeguards you, safeguards the client too. So fee book, which records the invoice number, the client, and very importantly, it captures the jurisdictional taxes that you've billed the client. Because this number, this amount of jurisdictional tax gets transferred over to how much of, provincial taxes that you owe the government, slightly moving away from illegal compliance to potentially the amount that goes into CRA compliance, for example. So let's take a quick look at the fee book itself. Data elements to keep in mind: the date of the invoice number. Again, ensuring that the invoice numbers are unique. You don't want to have multiple 001s. That could be confusing. The client for whom that invoice was generated, and what was the content of that invoice? What constituted the total amount to be paid on behalf of that invoice? Was it fees only? Was it disbursements only? Was it a combination of fees and disbursements? And finally, the appropriate taxes that were part of that invoice. What was the total amount billed in that particular invoice? Okay, so you can see once again, for Peter Piper, even though there was a retainer, it's important that you generate an invoice because that's the financial proof that work has been done by your legal firm to your client. Once you've generated a 565 on July 12th, on July 14th, you were able to do the trust transfer. So this piece of invoice 002, this particular is what's being expanded in the fee book. Okay? All right, so now we have 9 documents. Maybe this is the 10th. I lose track, but yeah, we've got 2 ledgers, 4 journals, that's 6. Potentially 2 reconciliation documents. If you want to do trust and ledger, then that's 8. Then there's, of course, the fee book, which is now 9. Comes certain jurisdictional documents. Each province has a few set of documents that are more particular how they, deal with their audits and bookkeeping aspects to it. For example, as I mentioned, I'm very familiar with the Form 9A. A lot of our clients in Ontario, when they do an electronic transfer from trust to general, are required to fill out this Form 9A, which is called the Electronic Trust Transfer Requisition Form. That was called Form 9A. Other set of documents that certain auditors may ask you for and are important for you to keep in mind and generate. As I mentioned earlier, anything to do with cash, very important. If you've got a cash money coming in, giving the client a receipt. If you're depositing cash, so let's say someone paid you $700 as payment, now you're depositing it into the financial institution. You're walking into, the actual bank, and you're depositing it with a teller and getting a slip, a deposit slip, which clearly states, yes, $700 was deposited on this date. And that's important because that's proof of you having deposited that money, right? And sometimes having duplicate cash receipts or retainer receipts help. So typically, when you look at a legal accounting software, you would notice that when you generate a retainer receipt, there are two sets of documents that are generated. These are some of the little nuances of legal accounting software that are more specific to the nature and compliance aspect of your legal business. Because accounting is common, is across all industries, but there are certain tricks to the trade, there are certain nuances, certain unique aspects of the legal accounting aspects. So a duplicate cash receipt, duplicate retainer receipts, very important for you to keep in mind as you accumulate these set of important, repeatable documents. Of course, after the basic 9 or 10 documents, you now have additional documents. But there's one thing underlying that's very interesting for you to keep in mind. If you have a system or a process, whether it's manual or automated, electronic or otherwise, online, offline, cloud-based, desktop-based, whatever may be the system that you have, if you can make that a repeatable process, because these set of documents, the data elements are not going to change from month to month. They remain to be the same. If you have a way of doing this for 1 month, then it's just a matter of the amount of transactions may vary, but the end resulting documents are going to be the same. So if you've got it right for 1 month, then you've got the process right, you've got the steps and the workflow right, and hence generating this for the next cycle of a time period should not be that hard. The truth inside those documents, of course, as I mentioned, the amount of transactions and the reconciliation aspects of it, all of that would change based on the nature, based on the number of transactions that you get in that particular period. Now, for a good example, if you're just getting started, and let's say for the first month you don't have any trust transactions at all, or maybe you've been running businesses for a while, but for whatever reason you've not got any trust money into a specific matter, it is still important that you do a ledger document and all these set of documents for that month. It still reflects that you had nothing coming in or nothing leaving. Of course, if you've had outstanding trust balances, that would reflect in that document. But if you're just getting started and there's nothing, it's a clean slate, you can still run a zero balance trust ledger just to be extra cautious, I guess, and extra evidential in showcasing that. And that leads me to the final slide, which is if these documents and the data elements required in these documents don't necessarily change as much, and if you can help yourself by building a process or rely upon best practices-based softwares out there that are purpose-built to generate these documents, because that was the reason why people invested money, invested time to run a company, to generate these documents, to support their clients in being successful, then of course doing the right research as a legal practitioner or as a growing legal firm, finding out these different software companies or services companies that can offer you these services can potentially reduce the amount of manual data entry and headaches that you as a business can avoid. But if you're telling me that you only have one transaction a month, you pretty much know what's going to happen. In the last leg of your running as a legal practitioner, you don't have those many transactions, then that manual system that you currently use, or any system that you currently use, hopefully it can reflect these expected set of documents that you're otherwise required to generate. So the Law Society does not mandate how you go about doing this. They just mandate that you do these set of documents and generate it on a timely manner. We're just saying, with everything that's running in your legal life, your business life, other aspects of business that you still need to manage, especially if you're a sole practitioner, then it's double whammy. We would love to point you in the way of first exploring legal accounting softwares that are purpose-built to do this. And pretty much come to the end of this particular session, where again I reiterate the nature of this particular CPD was to walk you through the Law Society's bookkeeping compliance requirements. We at uLaw, of course, are a legal accounting software. We do offer our software and services that are purpose-built for these reasons. But once again, every legal practitioner needs to do their own homework and research and understand and explore which software. There's other options as well, but you need to really be comfortable with the choice you're making. At the end of the day, the Law Society expects you to generate these documents as an output from your legal firm. We encourage you to, once again, do your homework, explore the options that you have. We're just reiterating that you do have those options today, and we hope that you would maximize those options for your own benefits. So I'll pause at this particular time as we come to the top of the hour and pause for any questions that you may have with regards to today's webinar. Well, thank you very much. I greatly appreciate the feedback. If you do have any additional questions and maybe it's not coming to your mind today, you're always welcome to email us at support@uLawPractice.com. Do provide us your feedback on this specific webinar or other topics that you would like for us to cover, and we'll be more than happy to do the needful to add that as part of our upcoming webinars list. If there aren't any more questions, I once again thank you for participating, and hopefully this was an informative session and your time well spent. Look forward to talking to you in our next webinar next Friday. Have yourself a great day. Have a great weekend. Stay safe, stay strong. Take care.